And is solving these questions taking up too much of your brain cells?
We have just the solution for you. Starting with cash dividends.
Here's some facts. Cash dividends are distributed to shareholders with a cash value. A declaration of cash dividend commits the corporation to a legal obligation, and the declaration and payment decreases both shareholders' equity and total assets. Steps to pay a cash dividend. 1. You must have sufficient retained earnings. 2. Have adequate cash. 3. Declare the dividend. And remember, dividends are not a liability until declared. Entries for cash dividends. Declaration date. You must debit cash dividends, credit dividend payable, and for your line of explanation, to record declaration of cash dividends. At this moment, dividends payable is now a liability. Payment date. You must debit dividends payable, credit cash, and for your line of explanation, to record payment of cash dividends. Remember to allocate cash dividends between preferred and common shares.
It is now time to learn stock dividends. Stock dividends are similar to cash dividends but are distributed in shares instead of cash. To demonstrate stock dividends, assume that ABC Corporation has $300,000 in retained earnings and 50,000 common shares. They decide to declare a 10% stock dividend, and the current fair market value of its shares is $15 per share. To determine the number of shares to be issued, multiply the stock dividend percentage, which is 10%, by the number of current shares, which is 50,000, which would equal 5,000 shares. In scenario A, no par value common shares will be used. When journalizing the declaration of a stock dividend, you would debit stock dividends - common. You would then credit common stock dividends distributable. To determine the amount to record, multiply the amount of shares issued, which is 5,000, by the fair market value, which is $15, equaling $75,000. A stated value of $10 will be used for scenario B. However, it is the same process for a par value share. Again, stock dividends would be debited by the amount that is determined by multiplying the fair market value and the number of shares issued. Common stock dividends distributable would then be credited like before. However, the amount is determined by multiplying the number of shares issued, which is 5,000, by the stated value, which is $10, which would equal a total of $50,000. You would then credit contributed capital in excess of stated value by the excess amount, which is calculated by multiplying $5 by 5,000 or subtracting the common stock dividends distributable amount from the stock dividends amount, which would equal $25,000. If the balance sheet is prepared before the dividend shares are issued, the distributable account would be reported under share capital as an addition to the common shares issued. When the dividend shares are issued, the common stock dividends distributable account is debited and the common shares account is credited. A stock split is similar to a stock dividend because it involves the issuance of additional shares to shareholders according to their percentage ownership. However, a stock dividend results in a decrease in retained earnings and an increase in share capital, whereas stock split causes a reduction in the legal capital per share. The purpose of a stock split is to increase the marketability of the shares by lowering the market value per share. For example, in a 2-for-1 split, one no par value share is exchanged for 2 no par value shares. If the shares have a stated or par value for say $10, then that one share of $10 stated or par value is exchanged for 2 shares of $5 stated or par value. A stock split only increases the number of shares and decreases the book value per share. It is not necessary to journalize a stock split. A memo entry noting the details of the split is enough. This picture illustrates the effect of a stock split. As you can see, shareholders' equity remains the same, but the total amount of shares increases and the book value per share decreases.
Moving on to prior period adjustments. Prior period adjustment happens when accounting policy changes and affects the comparison of net income to the prior year, or An error has been made in the prior year's net income. When adjusting prior period accounts or principals, you should do all 4 steps. 1. The corrected or new principal should be reported in the current year. 2. The cumulative effect should be disclosed in the next financial report. 3. All prior period financial statements should be corrected and restated. 4. All changes should be stated in the footnotes. As you can see, here we have the format of how to adjust an over or understatement in the account you need to adjust. Let X be the overstatement and Y be the correction. Remember, X minus Y is the difference. To journal correction entries, you must debit merchandise inventory, credit income tax payable, and retain earnings. Line of explanation should be to adjust for over or understatement of cost of goods sold in prior period. Change in accounting principles occurs when the principle used in the previous year is changed, making the current year difficult to compare. There is no formal entry required. Just make sure the change is stated in the footnotes.
Now you know the 3 dividends: cash dividends, stock dividends, and stock splits, and how to do prior period adjustments. Good luck studying!